Hi viewers, in this video we will be discussing the Unit 6 of Module Management Accounting and Applied Finance offered by Chartered Accountants of Australia and New Zealand. In this video we will be discussing about the performance analysis and the tools for performance analysis, which are ratio analysis, variance analysis and benchmarking process. Let's start with the lecture. So number one is, what are the tools available for performance analysis? The number one tool that we have available is trend analysis of financial performance over a period of time. Okay, like suppose if I give you an example, suppose we are doing a trend analysis of one of the information given as quarterly data and the other one is given as of annual data. We are comparing with that. What is the trend of expense? Suppose the expense percentage in quarterly data is 10%, so we can also say it might be around 10%, probably in that annual data as well. So that is a kind of trend analysis. Okay, and also in the trend analysis we have to analyze one thing, that how we are going to relate that analysis, like the data interrelationships. The key to finding interrelationship in data is being able to identify a common element. There must be a common element. Okay, the first thing is correlation and the second is causation. Correlation actually what it does is it reflects the extent to which two or more variables fluctuate together. So correlation is, if A increases, so the B also increases, but a little bit in a lower percentage. Okay, if A increases by 10%, so probably we can say the B increases 5%. If A decreases 10%, the B decreases 5%. That is the kind of correlation in between the variable A and variable B. But if we say the causation is reflects how a change in one variable causes a change in another. We have to say, if a variable A is increasing, so it is the cause of that relationship that brings B to change as well. So that is a cause. Okay, the causation thing. Now we go to the second thing. The second thing is a ratio analysis. In the ratio analysis, the quantitative analysis of financial and management reports. Quantitative analysis of financial and management report. So here we will be also discussing these things. The benefits of ratio analysis. The benefits are the data is readily available. Okay. And also the second is ability to make comparisons. We can make a couple of a kind of quantitative comparisons. The ability to analyze trends and to identify improvements and where the areas needs to be, where we can improve the data, where we can think of as a management, as being a part of a management accountant role, so we can identify where the improvement is required. But still there are a couple of limitations of ratio analysis. Number one is inconsistency in the ratio formulas used. Okay, and oversimplification of the analysis. We think of the ratio analysis as just oversimplification. We will dig a little bit deep into the ratio analysis and the couple of ratios that we have in this our chapter later on in these couple of slides. But the third thing is the variance analysis. So this is the kind of compares actual results against the expectations. What does that mean? That actually means in the variance analysis, we look into key reasons for performance variance analysis include compare actual. If suppose what we do is we compare with the actual results against expectation. What for example, in the quarter one, we were expecting a sales of 100 grands, but actually the sales happened to be $110,000. So this is a kind of surplus. The variance is $10,000, but it's surplus. It's good. But why this has come through? have what is the reason? Like that is the kind of variance analysis that tells us, are we overvaluing something? Are we charging clients a little bit more price? Has our markup been increased or something like that? Or our costs have been reduced? So this variance analysis actually tells where the problem lies. Okay. Now, in the benchmarking, the fourth tool is benchmarking. Benchmarking here I'm going to tell you is with the benchmarking, what the benchmarking is. Benchmarking is generally is a standard against which an aspect of business is measured. A standard. Suppose we have set a standard for an organization that if in industry, it can be in an industry, it can be in the same organization, it can be within the departments, and it can be in the different segments of one department. Okay, it's a benchmark, it's a standard that can be set for an organization to compare whether the other component of the same organization is performing in that benchmarking criteria or not. Okay, now the benefits of benchmarking we'll be discussing later on, and now start with the little bit more important topic, that is ratios. Now in the ratios there are four kind of ratios. Number one is profitability ratios. Even the name suggests, we can say the profitability ratios tells ratios that assess profitability. Okay, ratios that assess an organization's ability to generate income from its resources. This ratio will tell us how the organization, in which percentage the organization is assessing, the organization is working towards to achieve its profitability. Activity ratios, number two. Activity ratios actually ratios that deal more with how effectively a business's income producing assets are working. What does that mean actually? This actually means like the activities of the business are going well or not. This ratio will be actually telling you the activities of the business are effectively working or not. Okay. Now come to the liquidity ratios. This is definitely, it's the liquidity kind of ratios, which tells ratios that assess an organization's ability to pay short-term debt. The financing ratios are ratios that are useful indicators of returns to those who have financed the organization. Okay, the financing ratios. These ratios will tell. They are also an indicator of the financial risk associated with the way in which the organization is financed, leverage and interest cover ratio. Now, the most important thing is it is not sufficient to calculate ratios or say that they have gone up or down. This is a very important point as per the exam scenario. If you will be just stating that yes, this ratio has gone up or down, that is just restating the facts that might be given there. But what you have to do is you have to explain the underlying meaning of that increase and decrease. Why that has been decreased, why that has been decreased, or what is the link between its decreasing and increasing factor. Or in other words, we can also say if there is any change that happens, so we can say we can link the information given in the question with the ratios increase and decrease in percentage. We can link that information and we can elaborate that information in the exam so that we can secure our marks. Now let's start with the other thing is, the next is, now we will be discussing a couple of ratios that I told you earlier. Now the number one is a profitability ratio. In the profitability ratios, there are few components. In the profitability ratios, there are few components. Number one is the ratios that assess profitability. Okay, that is actually the gross margin ratio. The gross margin, we can say Gross margin is actually the equal to sales minus cost of goods sold divided by sales. This ratio actually tells each of these three ratios are shown as a percentage of sales. Now I will be telling you the ratios that assess. Now the second is EBIT, earning before interest and tax margin, divided by sales. Okay. And the operating expenses as a percentage of sales, the operating expenses divided by sales. What we're doing in these three ratios, just keep an eye on these ratios particularly. What we're doing, how are we going to interpret that? Each of these three ratios, if you look into it, all are divided by sales. Okay, allowing easy comparison between periods against budget or against an industry benchmark. Okay, watch for the impact of seasonality when making comparisons from one period to the next. Okay, so in these ratios, in assessing the profitability ratios, what we'll be doing, we will be analyzing comparisons from one period to the next one. Now come to the second part of the profitability ratios is ratios that assess an organization's effectiveness in generating income from its resources. These ratios will actually, what they do, these ratios will tell how effectively the organization is working. Okay, organization, it will be the quantitative information gives us information of the organization, that how effectively the resources has been used of the organization to generate the income. Okay, how are we going to do that? This is actually return on assets. Assets are our resources, so what return we are getting, we are achieving by utilizing our assets. This is divided by, this is actually earning before interest and tax divided by average total assets. The second is dividend payout. This is the dividend payout ratio to given to the shareholders. Okay, how are we going to calculate it? Total dividends to ordinary shareholders. So what we'll be doing, we will be just subtracting the preference dividends, because the preference dividend is a different thing. Okay, so net profit after tax that needs to be divided into the dividend into the shareholders, except preference shareholders. So that is actually the dividend payout ratio. Now what we're doing with the ROA, how are we going to interpret that? ROA can vary dramatically across different industries. A capital intensive industry will have a lower ROA than a service industry due to its higher investment in fixed assets. If a capital invest, what we're doing actually with the ROA, because we are dividing with the total assets of the organization. So definitely if the organization have a large assets, so the ROA will be lower. So if we'll be comparing the ROA of the large assets industry, so then we have to look into the similar kind of thing as a benchmark status. Now come to the dividend payout ratio, then how we're going to interpret that is ratios vary widely. This may vary. Large blue chip companies tend to issue larger dividend payments, while growing organizations tend to retain cash to fund expansion. Definitely the blue chip organization, they normally issue the dividend regularly, but definitely the smaller organization, what they're doing is they're starving for their expansion so that they can give a very good return to the investors, or return on their payout as a dividend in the future more, so they are thinking about their expansion. So this ratio might be less for the newer organizations. Now come to the another type of ratio. The other type of ratio is activity ratio. Activity ratios are 6. So ratios that deal more with how effectively a business's income producing assets are working. Okay, what does that mean? This means that organizations, if I say organization assets, how effectively those assets, income producing assets are working, how effectively those income producing assets are working, These ratios tell us that thing, the activity of the organization. What is happening in the activity of the organization? The number one is asset turnover. Sales divided by average total assets. Working capital. Sales divided by average working capital. Third, fixed asset turnover. Sales divided by fixed assets. Number four, inventory days. Now, these three ratios that we have already discussed, I'll be telling you a couple of more things about these things. So the asset turnover shows the conversion of an investment in assets into sales. Conversion of an investment in assets into sales. Take care comparing across industries, as some will more efficiently use assets than others. Then in that case it might be possible their assets useful life might be less as compared to those which are not using their assets, converting their assets into the sales. So just keep one thing in that mind, so balancing it out. And the fixed asset turnover is similar to assets turnover, but just for the investment in fixed assets only fixed assets. Now if we're talking about the working capital turnover, is similar to asset turnover, but just for the investment in working capital. Okay, so the asset turnover is the main thing. Now come to the inventory days. In the inventory days, what we're doing, average inventory multiplied by 365. Just consider 365 as a constant for your calculations, divided by the cost of sales. In the inventory days should be assessed in the context of seasonality, supply arrangements, consignment stock, or JIT, just in time. And the debtor days, average debtors multiplied by 365 divided by sales. Trade creditors days, average trade creditors multiplied by 365 divided by purchases. Sometimes it's written the purchases we have to calculate a couple of calculations as well, and the sales we have to calculate the backward calculations to calculate the sales. Now these are pretty much same. Debtors days should be assessed in context with the credit terms granted to customers, consider trends, performance against budget in comparison to competitors. Creditors days should be assessed in the context of the payment terms granted by suppliers, consider trends, performance against budget. So if the inventory days are higher, then we have to definitely consider why these inventory days are higher. And the debtor days are higher, it means are these debtor days are higher by some reason, or if it's more than 90 days, why this is more than 90 days. We have to consider these couple of factors, that why these are more than 90 days or something like that. We have to see or revise our policies for the debt collection and debt payments. Now the liquidity ratios. Now look into the liquidity ratios. What does that mean? Liquidity ratios are divided into actually two parts. Number one, ratios that assess an organization's ability to pay short-term debt. So whether the organization ABC is in a position to pay all its short-term debts or not. That's actually, in a simple words, that's actually a liquidity ratio. Number one is current ratio, current assets divided by current liabilities. Is the organization able to pay out its liabilities by paying its current assets? Okay, how are we going to do it? So current ratio of greater than 1 generally acceptable. It means its liquidity ratio is good. They can pay their debts. But service industry may comfortably operate on lower. Okay. Now, quick ratio or asset test ratio. The quick ratio is equal to cash assets and equivalents plus short-term investments plus short-term receivables divided by current liabilities. So why this is we're saying only these things? Because short-term investment we can sell them at any time. So that's why in the above ratio that has been distributed into a kind of quick ratio that can easily be. Suppose my current asset does have debtors, but in the debtor terms it means written 30-day time period or 60-day or 40-day. So in that case, I can't legally compel the people to pay on time. But with the quick ratio, what we're doing is we're just eliminating that factor that we have on a policy. So it is just considering what is actually liquid and immediately available. Okay, at the time of calculating this quick ratio, what is immediately available removes the issue of inventory distorting liquidity analysis. Now come to the financial ratios. Financial ratios does have two kind of types. Number one is ratios that are useful indicators of returns to those who have financed the organization. Return on equity ratio, ROE ratio. Return on equity actually means net profit after interest and tax minus preference dividends divided by average ordinary shareholders funds. Okay, this is actually the return on equity ratio. This will tell you on how much equity, on how much investment as an investor, on how much investment we are getting return. If it's 5%, 2%, whatever it is. Now come to the return on capital employed. This is if the capital is employed, then what is that return? What is that ratio? So in earning before interest and tax divided by average debt liabilities plus average ordinary shareholder funds. So return on equity actually that shows how effective management is at using equity financing to fund operations and grow the company. ROE can't be used to compare companies across industries very effectively as they have different levels of income and investment. Return on capital employed shows how effectively assets are performing while taking into consideration long-term financing. Now come to the second part, that is the debt ratios. Okay. The debt ratios is equal to total liabilities divided by total assets. Okay. A low debt ratio indicates if the low debt ratio that will be indicating that an organization is not highly leveraged, means it's not fully or not more likely to be believing on the liabilities or more likely to be, so it has good assets. While a high debt ratio indicates that it relies strongly on debt funding. Okay, and the second is debt equity ratio. Debt equity ratio, this total liabilities divided by total shareholder fund. How we're going to interpret that is this ratio mirrors the investment made by supplier and lenders against what shareholders have committed. Okay. Large companies with strong credit ratings may have a ratio over 100%. Okay. And interest coverage, the third one is interest coverage ratio. Earning before interest and tax, EBIT, divided by interest expensed and capitalized, reflects the ease with which an organization can pay its interest expense. When it is less than or equal to 1.5 times, it may be difficult for the organization to meet its future interest obligations, especially if interest rates rise. In the exam, what you have to do for these ratios are, when analyzing ratios, it is insufficient to say it went up or down or how it differs to a benchmark or target. Analyze it to determine the cause. What is the cause? What is the reason behind it? Or the implication, or what will happen if this thing has, yeah, with reference to the background. Okay, like you have to think about or mentioning the ratio in a little bit detail. I know. Now come to the second tool, that third tool that we have available is the variance analysis. Okay, the first was trend analysis, second was ratio, third is variance analysis that we're discussing now. In the variance analysis, what we do have is key reasons for performing variance analysis include. What are the reasons that we have? It is kind of to look for areas in which performance can be improved or where efficiency can be increased. Because what we're doing is actually we are identifying a difference um, between the expectation and the actual. So this will tell us, are we over emphasizing on something, or we are just exaggerating some information, or we are not doing a couple of other factors into account. So this is a kind of improved strategy. Excuse me. To increase an organization's learning and knowledge about its processes as part of a continuous improvement process. So what we're doing here is in variance analysis, because we will be just why this variance is coming from where this variance is coming from. So then what we're doing is organization learning and knowledge into account. And the third is to identify where standard costs are incorrect and need adjustment, if the standard costs needs an adjustment or not. Number 4 is to support the operation of future budgets. This will be supporting the future budget so that we can analyze our data in a very efficient manner so that we can calculate in the future in an efficient way. Variance analysis, actually what does it mean is causes of variance. Okay, we identify the causes of variances, and then effective management of performance that comes into being. Then we can analyze why this is that, why this is that thing has happened. Now come to the different types of variances. In the variances types, we're talking about the sales variance, direct material variance, direct labor variance, and overheads variance. These are the 4 types of variances. Okay, sales, direct material, direct labor, and overheads. Okay, number 1, sales. In the sales, we have a price sales variance, volume variance, mix, quantity, market share, and market size. Now come to the direct material. There will be price variance and efficiency variance. In the direct labor, there will be price variance, efficiency variance. In the overheads, we do have the overheads of 2 types, variable and fixed. In the variable, we do have spending variance, and we do have efficiency variance. In the fixed, there is a budget. That's the only one. Okay. Now the variance analysis. Sales volume variance. Sales. The price variance. In the sales, we do have 2 kinds of variance, the price variance and the volume variance. Sales price variance and the sales volume variance. So in the sales price variance is actually, there is a difference between actual selling price minus budgeted selling price multiplied by actual units sold. That will be price variance. Now come to the volume variance. This will be the same, but actual units sold, because it's volume units, it's talking about units. Previous one the price, so that's why there was price. Now it's a volume, it means a unit. Actual units sold minus static budget units sold. Budget units sold multiplied by budgeted contribution margin per unit. Okay, here what we're doing is contribution margin per unit. Now come to the sale. What we're doing here is now come to the variance analysis, the sales volume. So sales, so here again, sales mix variance, I told you, and the quantity variance. Okay, in the mix variance, actual total sales unit of all product, because it's a mix. In the mix variance, what we're doing is all of the products, we'll be collecting all of the products multiplied by actual sales mix percentage of this product minus budgeted sales mix percentage of this product. Okay, if we select one product and then we say actual sales mix percentage of a product and divided minus budgeted sales mix percentage of that product multiplied by budgeted contribution margin per unit of this product. Don't worry, you have these all formulas in the book, so don't worry about that. You don't need to remember it, but I'm just telling you here. The quantity variance is actual total sales units of all product minus budgeted total sales units of all product multiplied by budgeted sales mix percentage of this product, budgeted contribution margin per unit of this product. Come to that. Variance analysis. In the market, what we do in the market is market share variance and the market size variance, as we studied previously. In the share variance, market share variance, this is the share, actual market size in units, how many units has been sold in that market for that same product, multiplied by the actual market share minus budget market share, multiplied by budgeted contribution margin per composite unit. Size variance, market size variance, actual market size in units minus budgeted market size in units, multiplied by budgeted market share, budgeted contribution margin per composite unit. Variance analysis in the material, direct material. Okay, this is more important as compared to other ones. What are we doing? Price variance, actual minus standard in unit price. Okay, multiplied by actual input quantity. If efficiency variance, actual input quantity minus budgeted input for actual output multiplied by standard unit price. Okay. Now, first of all, we'll be doing. So, in the price variance, what are the common causes or the explanation? It might be changes in materials mix. It might be exchange rate movements. That's why the price is going variation. Direct material price variance is coming up. Failure to take advantage of discounts, quantity-based discounts, additional costs, freight, not factored into budget. Efficiency variance. In the efficiency variance, what we're doing here is changes in quality and specifications of materials, level of operator efficiency, non-standard production scheduling, technological changes. Now come to the next one. The next one is variance analysis of direct labor. In the labor, the same as like the direct material. Actual unit price. In the price variance, actual unit price minus standard unit price multiplied by actual unit quantity, input quantity. In efficiency, actual input quantity minus budgeted input for actual output multiplied by standard unit price. What is the reason of the price variance? Direct labor price variance. It might be changes in the sales of labor used, overtime payments, productivity bonuses, unplanned pay increases. But in the efficiency variance, what are the reason of that? Changes in the class of labor used, changes in general working conditions, changes in working methods, inferior material quality, insufficient training, lack of supervision, machine inefficiencies. Now come to the variance analysis, but overheads. It might be variable overheads and fixed overheads, as I told you earlier. Okay, the variable overheads, there is a spending variance. The spending variance is actually the actual rate minus standard rate multiplied by actual input quantity. This is a spending variance. Okay, what are the reason of that spending variance? Is a change in the nature of overheads, incorrectly splitting overheads fixed or variable. We have incorrectly splitted them. Utility cost changes. Now come to the efficiency variance in the variable overhead is actual input quantity minus budgeted input for actual output multiplied by standard rate. Why this is coming through? What are the causes of that? Incorrectly splitting overheads fixed or variable, stoppage and strikes, number and length of machine breakdowns, change in driver used for allocation. Now come to the fixed overhead, budget variance, actual fixed overhead cost minus budgeted fixed overhead cost. And now, what is the reason of that? Unplanned cost, contract variations, renegotiated fixed cost risk transactions. Now we are moving to another important topic, that is a benchmarking process. In the benchmarking process, the first step that we have to follow is in the benchmarking. What is actually the benchmarking? It's the process of evaluating the performance of one organization We are evaluating the A, B, C organization performance with a C, D, E, F organization, or with the same organization, or with the different segments of the organization, or with different kind of departments of the organization, that of another or one part of an organization against another. So implementing the benchmarking process is, first of all, what we have to do is identify the product, service, or process that needs to be benchmarked. Okay, what we're doing? What we're doing is, first of all, we are identifying what needs to be benchmarked. It might be result-based benchmarking, or it might be process-based benchmarking. Okay. In the result-based benchmarking, it might be comparing performance metrics such as defect rates, absenteeism, debtor days, and overhead costs. This might be result-based. But if it's the process-based benchmarking, then comparing the internal process that derive the reported matrices, setup or processing times. Come to the second point. What is the second point? Is identify and select the benchmarking target. There should be a target. What we have to do is identify which external or which internal benchmark can be used. It might be competitors as a target, internal benchmarks, or might be standard. Okay, if it's a competitor or industry benchmark, then direct competitors are from a broader competitive set. Internal benchmark, benchmarking parts of an organization against different parts of the same organization. Standard or analogous benchmarks, benchmarking against disappeared organizations that share generic processes. Now come to the third point. Third point is collect and analyze data to identify areas performing below best practices. Now what we have to do is we have to collect the data, which areas performing below the best practice. Because in the benchmark, what we have done, we have set a best practice. If our performance is not that best performance, so what are now we have to identify those things, those areas. So publicly available external data or attainable internal data. Then the number 4 will be set benchmark targets. It is not necessary for the benchmarking participants to share the same organizational attributes such as size, industry. And what we have to do, then we have to, it is best to eliminate the impact of foreign exchange variations from the matrices that are used. Now the number 5 and 6, these are outside of the scope of the MAAF121. Implement changes to achieve best practices, follow up the ensure that best practices being achieved. Now come to the last thing is that what are the benefits of benchmarking? So the benchmarking benefits are, the number 1 benefit is help identify specific problem areas and eliminate guesswork. We cannot guess in the organization if we're working in that. Okay, it's a kind of identifying specific problems. What is the problem in that? Number 2 is enable an organization to establish how its performance compares and take action to improve performance. What action needs to be taken to improve our performance? Okay. Number 3 is how can we train our management so that in the future that problem which have occurred now should not occur in the future? Can be used to educate and train management and employees on the latest and best practices being used and achieved. Number 4 is the targets are achievable. Shows that performance targets are achievable, that's why the other organization has achieved. So the organization or the management or the employees cannot say this cannot be achieved. Number 5 is serves as a performance measurement tool. This tool is serving as a performance measurement tool. Now what are the limitations available? This is like favorable comparison may lead to complacency. Often does not provide underlying factors that generated the results. May lead to behavior not congruent with organization goals. So these are a couple of limitations that you have to discuss. Now coming to the important thing that is very important, that's the dashboard reporting. Even you can see visual representation of information that summarizes essential data into a range of formats. You must have seen these kind of information in management reports, or sometime if you do the prospectus of an organization, or sometime to the shareholders report or the annual report that's been published to the organization and given to the ASX. So these dashboard reporting are what you think is more when you see on that report, what you see actually. This is kind of physical or a kind of visual representation, because everybody says the visual information can be understood by everyone. It doesn't need to be. It's just self-explanatory. Okay, that's why this is the dashboard reporting. I'm just telling you that thing as well. And the traffic light reporting is a conveys information in a visually arresting way. You can see the traffic light reporting, 3 lights. If it's red, means it's in red, and it is risky. But yellow is a little bit less risky, but and green is good. Highly visual based with green, yellow, or amber, and red highlighting aspects of the business that are performing well, acceptably, and poorly, respectively. Now come to the dashboard reporting. There are a couple of benefits as well. In the dashboard reporting, the benefits are communicate and highlight key organizational and departmental measures. It highlights the key organizational and departmental measures, key measures, what has been taken there. Trends are often more visible, so anybody can understand, okay? Often allows user to drill down to a lower level of data. They can drill down lower level of data. If they want an information on sales, they can just see the note and they can go and dig up in that information why that sales has been decreasing. Even they are saying, I'm just asking a question from just a hypothetical example, why the sales, they have to dig down that information. So that's why I'm saying why the sales are decreasing and the debtors are increasing. Why is that? So if they have to dig that information, they have to go into the financial statements. Now come to the provides a consistent view. This will be providing a consistent view. In the previous year that was that, but now this has been that. So it means this is giving us information that's be consistent and visually representable, often capable of customization. Sometimes we can customize it according to our needs. Hopefully you enjoyed that lecture. If you haven't subscribed my channel, you can subscribe that and you will get a very useful information on a couple of more things that we're discussing in the future. Bye for now. We'll be meeting you in the next lecture.